A favorable result can look like good news, but what if the company spent less overall while still using more than planned? In this video, you will learn what variable overhead means, how total variable overhead variance is calculated, and how to break it into spending variance and efficiency variance so managers can make smarter decisions. Overhead includes costs that support production but are not traced directly to one specific unit. These are indirect costs that help the process run, like supplies, indirect labor, and some utility costs. First, let's separate two big categories. Fixed overhead stays the same in total, even when activity changes within the relevant range. Variable overhead changes in total as activity changes. When production goes up, total variable overhead usually goes up too. For example, imagine maintenance support costs $10 per unit. If the company makes 1 unit, total maintenance support is $10. If it makes 10 units, total maintenance support is $100. That is why we call it variable overhead. Companies compare what they actually spent on variable overhead with what they should have spent for the actual level of output. That difference is the total variable overhead variance. It is actual variable overhead minus applied variable overhead. Let's work one example. A company produced 1,000 units. Its standard allows 0.15 direct labor hours per unit. Actual hours were 200. The standard variable overhead rate was $10 per hour. Actual variable overhead was $1,200. Step 1 is to find the standard hours allowed for actual production. We take 0.15 hours per unit and multiply by 1,000 units. That gives us 150 standard hours allowed. In other words, that is how many hours the company should have used for this level of output. Step 2 is to calculate applied variable overhead. We multiply 150 standard hours by $10 per hour, which gives us $1,500. Now compare actual overhead of $1,200 with applied overhead of $1,500. The difference is negative $300, which means a $300 favorable variance because the company spent less than planned. Here is a very common mistake. Students sometimes see a negative number and assume it must be unfavorable. But for cost variances, spending less than expected is favorable. The sign tells you the direction of the difference. You still have to interpret whether that difference helps or hurts the company. So far, we have defined variable overhead, calculated the total variable overhead variance, and seen why a lower actual cost can create a favorable result. Ready to lock it in? Tap the link for study guides and flashcards on this topic so you can keep learning without missing a beat. Now let's go deeper. A total variance tells you the final difference, but not the reason. To find the cause, we split it into two parts: the spending variance and the efficiency variance. The spending variance asks a simple question. Based on the actual hours worked, did the company spend more or less on variable overhead than expected? The formula is actual variable overhead minus actual hours times the standard variable overhead rate. Using the example, actual hours are 200 and the standard overhead rate is $10 per hour. That gives an expected amount of $2,000 for the hours actually worked. Compare that with the actual overhead of $1,200. The difference is negative $800, so the spending variance is $800 favorable. That favorable spending variance suggests the company paid less than expected for the variable overhead tied to those hours. Maybe supplies cost less, maybe utility use was lower, or maybe indirect support costs came in under budget. The variance tells us something happened, but managers still need to investigate the cause. Next is the efficiency variance. This one focuses on time. It compares the actual hours used with the standard hours allowed. then values that difference at the standard variable overhead rate. Actual hours were 200, but standard hours allowed were only 150. That means the company used 50 more hours than planned. Multiply those 50 hours by $10 per hour, and the efficiency variance is $500 unfavorable. This is the key idea. The company still has an efficiency problem, even though the total variance looks favorable. It spent less overall, but it took longer than expected to do the work. A good manager would not stop at the total number. Here is a simple method you can use every time. First, find standard hours allowed for actual output. Next, calculate applied overhead, then find the total variance. After that, split it into spending and efficiency variances. Finally, interpret each result carefully before jumping to conclusions. Now let's apply the same logic to a new case. Suppose a company makes 500 units, allows 0.20 hours per unit, uses 90 actual hours, has a standard variable overhead rate of $8 per hour, and spends $760 on actual variable overhead. Standard hours allowed are 100. Applied overhead is $800. Total variance is $40 favorable. But look at the breakdown. The spending variance is $40 unfavorable because the company spent more than the standard amount for the hours actually used. The efficiency variance is $80 favorable because it used fewer hours than allowed. Together, those still reconcile to a $40 favorable total variance. These two examples show why the breakdown matters. One company spent less but used too much time. The other company spent more per hour related overhead than expected, but finished in fewer hours. The same formulas reveal very different management stories. To recap, total variable overhead variance compares actual overhead with applied overhead. Spending variance asks whether overhead costs were higher or lower than expected for the hours worked. Efficiency variance asks whether the company used more or fewer hours than the standard allowed. Now that you've watched the video, let's see how much you remember. Head to the link in the description where you'll find Quizlet content made just for you.